Hi, and welcome back to another episode of The Mortgage Musketeer, where today I'm going to be talking about underwriting. What does underwriting mean when it comes to buying a house? Okay, when it comes to buying a house, what underwriting is the process where all of your application and all of your loan documents are sent to the lender, who has an underwriter who will then use all of the documentation and compare everything in your loan against underwriting guidelines. Now that's a big simplification. What does that really mean? Okay, so the first step was taking the loan application. The second step to be pre-approved was getting the loan documents that support it. Your bank statements, your pay stubs, your W-2s, copy of your driver's license, all those things, getting that to your loan officer. So the loan officer has taken an application and gotten all of this documentation and all of your information, and it's generated your debt to income ratio. They've determined what your income is. They've done all this up front. Now it is sent to the lender, where an underwriter is going to review all of that based off of the lending guidelines, and that is where it gets a little bit more complicated, because you think, okay, we put it all together, here you go, and they sign off on it. An underwriter is somebody who underwrites a loan, and where that comes from is the idea of assuming risk. So originally, an underwriter would sign their name underneath a loan, and it's under the loan, whereas the underwriter, they have assumed the risk of this loan. And that's something that you have to keep in mind. When you are applying for a loan, you're a risk, right? Even if you have the best income and the debt to income ratio and the best credit score in the world, you're still risk. You might be less risky than other people, but an underwriter is going to determine the level of risk based upon your loan documents, your debt to income ratio, how much income you make, and all that stuff goes into it. But there's more. So there's more to just turning in your documents, because in order to complete a loan, you also have to have homeowners insurance. So ultimately, after you choose your homeowners insurance, that policy is going to go to the underwriter, and the underwriter is going to look at it and ensure that that policy protects their investment. Because let's say that you're only putting down 5%, or even if you put down 20%. In either scenario, you own 5% or you own 20% of the home, but the lender is technically responsible for the other 95 or 80% of that loan. So they're assuming the vast majority of the risk, and they need to ensure that their house, their investment, is properly insured. So they're going to underwrite, they're going to take a look at that policy and ensure that it meets acceptable risk levels that they're willing to assume to protect their investment. There's also an appraisal. An underwriter is going to be looking at the appraisal as well. So we order the appraisal. The appraiser goes out there, appraises the property. They go through, take a look at it, and if it's a government loan, FHA, VA, or USDA, there's a little inspection component to it. All that is assuming or showing an acceptable level of risk. If, for instance, there's no handrails on a government loan, it'll come back subject to completion. That appraisal will, and you'll have to get the handrails up. Again, risk. All right, so that's a safety piece to it. So once the appraisal is complete, the appraisers are going to write it up, and they're going to turn it into typically an appraisal management company. The appraisal management company is then going to review it, do a quality control, and if there's any admin errors, they're going to kick it back for the appraiser to correct. Appraiser's going to correct it, send it back to the appraisal management company. Once the appraisal management company says, okay, we're good, they'll forward it off to whoever ordered it. And then it's up to them to get it to the lender. And once it gets to the lender is going to review the entire appraisal. In that appraisal, there's all kinds of stuff that they're looking at, and were there sufficient comps? Does it make sense? Was the appraiser just making stuff up? The appraisers have a database, and depending on how many errors and how many issues historically lenders have found, it's like a report card. So there are risk levels within an appraisal as well. So if it assumes too much risk, an underwriter might say, hey, we need a second opinion, or we need a desk review. And a desk side review is where they have an independent appraiser, normally within their company, who's going to review the documents and make sure that it actually makes sense. Okay, so there's multiple levels of quality control that they're going to look at with that appraisal. And if there's any issues in that appraisal, they're going to kick it back to the appraiser to address. Or if it comes in low, then that's an issue, because basically the property isn't being evaluated for what the sales price is. So there's a lot of pieces that go into that. All that an underwriter is going to look at, right? Then on top of all of that, you also have title, and title is a big piece to this. So the title company has to go through their search, make sure there's no liens. They're going to do a check on the property to see what the tax assessment was. They're going to do all kinds of stuff that from the legal side to ensure that this property, this legal entity, has or is cleared to be sold without or minimal risk to the investor and to the buyer. Okay, so all that is being done, and once title is complete, it is submitted to underwriting, and underwriting is going to review it and make sure everything is good. So there's multiple pieces in addition to just the borrower that are involved with what the underwriter is looking for, and this goes into the loan process, right? So when the loan process begins, title is ordered, appraisal is ordered, and you should be looking for your homeowner's insurance. Now, I tend to get a quote for my clients. I try to, because I know good insurance companies, but by no means are they bound to whatever I got. As a matter of fact, in the state where I operate, mostly in Kentucky, there are several documents that state that a buyer can choose whoever they want for homeowner's insurance. Absolutely. Okay, but the key is to that, you need to get it quickly, because it has to get to underwriting. So all these documents are going through this loan process. Now, once you submit the initial loan documents and all that other stuff is ordered, it's going to go through its initial round of underwriting, meaning that the underwriter is going to receive your file based on everything that you have in there, and they're going to evaluate the income, and that's based off of the pay stubs and the W-2s and anything else that is provided, maybe a verification of employment. Now, this is why it is so important for you to think about everything that you turn into your loan officer as your lending resume. Because if the underwriter can't read it, they're going to kick it back. Why would an underwriter want to struggle through something that is faded and cut off or is not professional? This is your loan application. This is like applying for, this is an interview. Okay? These are your supporting loan documents that you need to put your best foot forward to say, look, I'm a qualified buyer, assume risk with my loan because I'm good for it. That's what you need to be thinking about. So when your loan officer is asking you for documentation, you need to get them in the best possible manner, crisp and clean and legible, so that they can see everything that's on there. Because if there's any doubt, ultimately what's going to happen is an underwriter, assuming that risk, they're underwriting that loan, they're signing off on it. If they don't think that this loan is worth them putting their name on it, in other words, they think it's too risky, they can say no. And that happens from time to time. So a loan officer, we do the best that we can to kind of pre-underwrite a loan as best as we can, to kind of look at it and see what is going to get caught and what won't. But occasionally, we'll do all of our due diligence and submit it to an underwriter. And an underwriter, because it's somewhat subjective, they can still say, no, I don't think that this person is worthy of assuming risk. That doesn't happen as often with conventional loans, because conventional loans are pretty straightforward, and buyers that are buying a conventional loan are pretty much straightforward. But when you're dealing with government loans, there's some overlays and there's some additional guidelines in there, particularly FHA. They have a different level of risk that they assume, because if let's say an FHA underwriter signs off on it, and then later on, once this loan is then reviewed in quality control afterwards, or maybe it's being sent to be purchased, it has to be accepted by FHA. It has to meet their standards. So if they review this loan, and they say, hey, underwriter, you didn't do good, this doesn't work, they actually have to buy that loan back and service it at pennies on the dollar. So it is expensive, and it's a ding against the underwriter. So some underwriters aren't willing to assume much risk at all. They're very by the book, straightforward, dot every I, cross every T, because they're nervous about their license. Some underwriters, having experienced a lot more loans and know what's going on, will assume a little bit more risk because they understand the parameters better about what they're dealing with. Now this is where it's handy having a broker instead of just a bank, because if it goes into underwriting and the underwriter takes a look at everything and goes, no, I'm just not going to accept the risk. Well, with a bank, you're done. The file's dead. With a broker, an underwriter tells me that, and I know, hey, I've done my due diligence, this person should be approved. I have multiple lenders that I can send it to, and I can say, okay. So I'll pull it from that lender and send it to a different lender. And normally there's kind of a hierarchy, because when we send a loan to a lender, we're trying to get the best fit. But if we're at a point where that lender is saying, hey, we may not accept the risk, then it becomes a, let's get this loan closed. At which point I'll send it to where I think it will be accepted, and I will grease the skids, and I will call lenders and say, hey, this is my scenario, what do you think about this? And they'll say, yeah, we'll do that, and we'll submit it, and we'll get the loan closed. We get the deal done, which is, in my opinion, why brokers are better than banks, because we have a myriad of loan products that banks may not have, and we have a lot of flexibility, because it all comes down to who's willing to accept that risk. All right? So all of this goes into the underwriting process. It's an overarching view, and there's a lot more details within that process, but understanding what they do is important, because once it's submitted, they're going to say, okay, hey, this loan is approved with these conditions. And what that means is, I've looked at everything and I approve the loan, but I want some additional documentation. Now that documentation is then conditions. So we'll receive that, and then we'll send it to the buyer and say, okay, hey, these are the documents that I need. And this will go a couple rounds, but you have to understand that whatever we're asking for is what the underwriter is asking for in order to final approve your loan. So the longer you take to get that to us, the longer your loan process is going to take. And that's why people ask, well, how long does underwriting take? How long will it take your client, or how long will it take the buyer to get me the requisite loan documents to clear their loan? Everybody's different, so there's no cookie cutter here. Here's exactly what you need. We know the base loan documents, but after that, it's all about your specific file and what your underwriter is asking for to accept risk and approve your loan. So think of it like the hot potato. I've talked about this before. When they tell us we need these documents, we're going to get them to you. You as the buyer need to get them back to us as soon as possible. Hot potato. I don't want it, give it to you. You don't want it, give it back to me. I don't want it, give it to underwriting. That makes your loan process go a lot faster. Okay. All right. So once all of that is accepted and they say, yes, I've looked at everything you gave me, I approve, I've looked at the appraisal, I've approved it, I've looked at homeowners insurance, I've approved it, I've looked at title and I've approved it, everything looks good, you are clear to close. That's when you have final approval, and then you can go to the title company and sign all the final loan documents. But until that point, you're approved with conditions. Get those conditions back as soon as possible. All right, hope this helps. If you have any questions, leave them in the comments below. Please hit the subscribe button and the like button. And until next time, it's all for one and one for all.